Rideshare giant Lyft is going public on Friday, and the company is so confident of investor interest that the company upped the price range today. But as KPIX 5's Melissa Caen shows us, if you want to buy shares, be sure to read the fine print. As always, right, Melissa?
Of course, you should always read the fine print, but especially when it comes to tech companies going public. We're here at the Lyft headquarters in San Francisco, where as of Friday, members of the public can buy a piece of the company and presumably have a say in how the company is run. But that might not be true here. Starting Friday, 4 new letters will appear on the New York Stock Exchange, LYFT. The public will be able to buy and sell shares of Lyft. And as Jeremy C. Owens with MarketWatch points out, they'll have a say in how the company is run.
Everybody with a share gets 1 vote.
But there's something you should know. Lyft is issuing 2 kinds of shares. One class for you and me, each share has 1 vote, but there's another class for insiders, and each share has 20 votes. This allows certain people to keep control over the company.
They want to make sure that while they take Wall Street's money, they don't have to take Wall Street's advice all the time.
Lyft is far from alone. This has become a common practice for tech companies. When Groupon went public, insiders got shares worth 150 votes. Facebook, LinkedIn, and Google insiders, they got shares worth 10 votes. Snapchat insiders got shares worth 10 votes too, but the public didn't even get 1 vote. Snapchat sold shares worth 0 votes. Owen says Snapchat's sale of 0 votes got people's attention.
That was when everybody realized where this was headed, that if Snap could get away with it, then a lot of other tech companies were going to try as well.
So some stock indexes, like the S&P 500, banned companies who issue different voting rights. And while some investors may like the idea of giving certain people control, there can be a downside.
If those founders mess up, in the way that Mark Zuckerberg has at times, in the way that Travis Kalanick did at Uber, there's going to be no recourse. If they don't want to leave, there's very little recourse because they have control.
In the case of Lyft, with 20 times the voting power per share, after the IPO, Lyft's president and CEO will hold a combined 49% of the company's total voting power. Owen says investors who want to bet on ride sharing should be careful because you're not really buying shares of a company.
When you're buying these shares, you're just investing in people and not the company.
Now, the reason this 2-class system is different than issuing 1 class and just hoarding a number of those shares at the top is that with the 2-class system, that public class can be diluted, it can be separated, it can be reissued without impacting that control group at the top. Live in San Francisco, Melissa Caen, KPIX 5.